Imagine two people who both graduate college at the same time. They both get good jobs, they both earn roughly the same salary. Every month, each of them manages to save $500. The first person deposits every dollar into a savings account. The second invests the same amount into a diversified portfolio. Fast forward 30 years, who do you think has more money? Most people assume the answer is obvious, the investor. But the interesting question is, why? Why does investing build wealth while simply saving money often doesn't? The answer has nothing to do with being smarter, or luckier, or finding the next apple before everyone else. It starts with understanding one simple idea. Money that sits still slowly loses value. Now, that might sound strange. After all, if you have $1,000 today, you'll probably still have $1,000 sitting in your bank account next year. So how could it possibly be worth less? Because of inflation. Inflation is the gradual increase in the prices of goods and services over time. Think about what $10 could buy 20 years ago, maybe a full meal at your favorite restaurant. Today, that same $10 might barely cover lunch. Your money didn't disappear, its purchasing power did. This is why people invest, not because investing guarantees you'll become rich, but because leaving money sitting in cash almost guarantees it will lose purchasing power over long periods of time. Investing gives your money the opportunity to grow faster than inflation. Instead of your dollars sitting still, they begin working for you. And that brings us to one of the biggest misconceptions about investing. Most people think investing means buying stocks, but that's only one piece of the puzzle. Investing simply means using your money to purchase assets that have the potential to increase in value or generate income over time. The word asset gets thrown around a lot, so what actually is one? An asset is something you own that has the potential to put money back into your pocket. That could be a business, a rental property, a bond, an ETF, or a stock. On the other hand, a liability is something that costs you money instead of making you money. Understanding that difference changes the way you look at almost every financial decision. Now let's talk about stocks, because despite what social media might tell you, stocks are not lottery tickets. Imagine Apple. It's one of the most valuable companies in the world. Millions of people buy iPhones, millions use MacBooks, millions pay for Apple Music and iCloud every month. Now, imagine taking that entire company and dividing it into billions of tiny pieces. Each one of those tiny pieces is called a share. When you buy one share of Apple, you're buying an ownership stake in that business. You're not betting on random numbers moving around a screen. You're becoming a part owner of a real company that designs products, hires employees, earns profits, and competes with other businesses. If Apple becomes more valuable over time, your small piece can become more valuable too. That's investing. You're buying ownership in productive businesses. But stocks aren't the only investments available. Let's look at bonds. When you buy a stock, you're becoming an owner. When you buy a bond, you're becoming a lender. Instead of owning part of a company, you're lending money to a government or a corporation. In return, they agree to pay you interest and eventually repay the amount you originally invested. Generally speaking, bonds are considered less risky than stocks, but because they usually involve less risk, they also tend to offer lower long-term returns. Different investments serve different purposes. That's why many investors own both. Now let's talk about one of the greatest investing inventions ever created, the index fund. Imagine someone asked you to buy shares of 500 different companies: Apple, Microsoft, Amazon, Costco, Visa, Coca-Cola. Buying them individually would take time, research, and a significant amount of money. An index fund solves that problem. Instead of buying hundreds of companies one by one, you buy one investment that already owns them. If investing simply owning great businesses, why do stock prices sometimes crash overnight? And why do markets seem to move even when nothing appears to have changed? To answer that, we first need to understand how the stock market actually works. Let's dive into that next.
If investing is simply buying ownership in great businesses, why do stock prices move every single day? Why can an incredible company suddenly lose billions of dollars in value overnight? And why do markets sometimes crash even when nothing seems to have changed? The stock market doesn't price what's happening today. It prices what investors believe will happen tomorrow. Think about it this way. Imagine Apple announces record-breaking profits. The company earns more money than ever before. Everything looks incredible. You'd probably expect the stock price to skyrocket. But sometimes it falls. How is that possible? Because the market already expected Apple to have an incredible quarter. Maybe investors thought profits would grow by 20%. Instead, they only grew by 15%. Even though the company had one of its best quarters ever, it still disappointed expectations. That's because stock prices don't simply reflect how good a company is. They reflect whether the company performed better or worse than investors expected. The market is always looking forward, never backward. Every day, millions of investors around the world are trying to answer one question: what will this company be worth in the future? Some believe it'll grow. Others believe it'll struggle. Now let's introduce another important idea: supply and demand. Imagine Taylor Swift announces a surprise concert with only 5,000 tickets available, but 500,000 people want to go. What happens? The price goes up. Not because the tickets suddenly became better, but because demand is much greater than supply. The exact same thing happens in the stock market. If thousands of investors suddenly want to own NVIDIA because they believe artificial intelligence will dominate the future, more people are trying to buy than sell. Prices rise. Now imagine the opposite. A company reports disappointing earnings. Large investors become worried. Suddenly, everyone wants to sell, but very few people want to buy. The only way sellers can attract buyers is by accepting a lower price. That's why stocks fall. At its core, the stock market is simply millions of buyers and sellers constantly negotiating the value of businesses. But prices aren't influenced by earnings alone. There are dozens of factors investors pay attention to: interest rates, inflation, employment data, consumer spending, oil prices, technological breakthroughs, government policies, global conflicts. Even something as simple as a CEO's comments during an earnings call can move billions of dollars in market value. Imagine you're buying a house. Would you pay the same price if mortgage rates suddenly doubled? Probably not. Higher borrowing costs mean fewer buyers can afford expensive homes. The same principle applies to businesses. When interest rates rise, companies pay more to borrow money. Consumers often spend less. Growth slows. As a result, investors may become less willing to pay high prices for future profits. That's why interest rates often have such a powerful effect on the stock market. Inflation works in a similar way. When businesses face higher costs for labor, materials, transportation, or energy, their profits can shrink. And since investors ultimately care about profits, stock prices often react. Now here's something that confuses many beginners. People often think a falling stock price automatically means the company is failing. That's simply not true. Let's go back to 2020. When COVID spread around the world, the stock market collapsed, businesses closed, travel stopped, entire industries came to a standstill. Within weeks, markets had fallen by more than 30%. Headlines were terrifying. But something remarkable happened. Markets recovered. Not immediately, not without volatility, but over time. Many of the same companies people rushed to sell eventually reached brand new all-time highs. This is one of the biggest lessons every investor needs to learn. The stock market often reacts emotionally in the short term, but over the long term, it tends to follow the growth of businesses and the economy. That's why experienced investors don't obsess over what happened today. They're asking a much bigger question. Will this business likely be worth more 10 years from now? If the answer is yes, short-term price swings become far less important. Which brings us to one of the most misunderstood words in investing: volatility. Most people think volatility means danger. It doesn't. Volatility simply measures how much prices move. Some investments barely move at all. Others can rise or fall several percent in a single day. That movement feels uncomfortable, especially when your own money is involved. But volatility and risk aren't the same thing. Successful investing isn't about predicting every market movement. It's about understanding why those movements happen in the first place. Because once you understand how markets work, you stop reacting to every headline. And that's exactly what we'll uncover next.
If you've made it this far, you already understand something most people don't. You know that investing isn't gambling. You know that stock prices move because of expectations, not just headlines. And you know that volatility is a normal part of the market. So here's the obvious question. If millions of people have access to the exact same information, why do so few become successful investors? It's not because they lack intelligence. It's because they lose a battle that's happening inside their own minds. The stock market is one of the few places where your emotions can become your biggest financial liability. Let's imagine two investors. They both buy the exact same investment on the exact same day. One investor sticks to their plan, continues investing every month, and ignores the daily headlines. The other checks their portfolio every morning, every lunch break, and every night before bed. When prices rise, they feel like a genius. When prices fall, they feel like they've made a terrible mistake. Guess which investor usually earns better long-term returns? The first one. Not because they picked better investments, but because they made fewer emotional decisions. One of the biggest reasons investors lose money is something called FOMO, the fear of missing out. Imagine hearing that everyone around you is making money investing in one particular stock. Social media is talking about it, news channels are covering it, your friends won't stop mentioning it. Every day, the stock keeps climbing higher. Eventually, you start thinking, what if this keeps going up without me? So you buy, not because you've researched the company, not because you understand the business, but because you're afraid of being left behind. Ironically, this is often when the excitement is at its highest and the price is already far above where it started. Now imagine the opposite. The market suddenly drops 20%. Every news headline says a recession is coming. People start talking about another financial crisis. Instead of thinking, great, I can buy quality businesses at a discount, most people think, I need to get out before I lose everything. So they sell. Without realizing it, they've done the exact opposite of successful investing. They bought after prices became expensive and sold after prices became cheaper. This happens because of something psychologists call loss aversion. Research has shown that losing money feels significantly more painful than gaining the same amount feels rewarding. If I handed you $100, you'd probably be happy. But if I took $100 out of your wallet, it would probably bother you much more. Our brains are wired to avoid losses. That instinct helped humans survive for thousands of years. But in investing, it often works against us. Another common mistake is trying to time the market. People convince themselves they'll wait until the perfect moment to invest.
Maybe after the next crash, maybe after the election, maybe after interest rates fall, maybe after the economy improves. The problem is, nobody consistently knows when those moments will happen. Not professional investors, not economists, not even the world's biggest hedge funds. The market often begins recovering long before the news becomes positive again. By the time investors feel comfortable buying, much of the recovery has already happened. Legendary investor Peter Lynch once said, far more money has been lost by investors trying to anticipate corrections than in the corrections themselves. Think about that. Many people spend years waiting for the perfect opportunity, while the market continues growing without them. Now let's talk about another dangerous habit, checking your portfolio every single day. Imagine planting a tree in your backyard. Would you dig it up every morning to see if the roots are growing? Of course not. You'd understand that growth takes time. Yet that's exactly how many people treat their investments. They expect meaningful progress every day, every week, every month. But investing doesn't work that way. There will always be good years, bad years, bull markets, bear markets, periods where it feels like nothing is happening. The investors who succeed aren't the ones who avoid those periods. They're the ones who stay invested through them. This is one of the reasons Warren Buffett famously said, the stock market is a device for transferring money from the impatient to the patient. It's one of the simplest quotes in investing, but also one of the most powerful, because wealth isn't usually built by making one brilliant investment. It's built by making hundreds of boring, consistent decisions over many years, adding money regularly, ignoring short-term noise, trusting the process, and allowing compounding to do its work. At the end of the day, investing is much less about predicting the future and much more about controlling yourself. The market doesn't care how confident you feel. It doesn't reward excitement. It doesn't punish fear. It simply reflects millions of people making decisions every single day. Let's finish with the most important question of all. If chasing trends doesn't work, if timing the market doesn't work, and if emotions are the enemy, what actually builds long-term wealth? That's exactly what we'll explore next.
We've covered what investing really is. We've looked at why markets move, and we've explored why so many investors unknowingly sabotage their own success. Now comes the most important question. If that's what doesn't work, what actually does? The answer might surprise you, because building wealth through investing isn't about being the smartest person in the room. It isn't about predicting the next market crash. Let's start with one of the most powerful forces in all of finance, compound interest. Imagine you invest $1,000. After 1 year, it grows by 10%. You now have $1,100. The following year, you're no longer earning returns on $1,000. You're earning returns on $1,100. The year after that, you're earning returns on an even larger amount. Your money begins making money. Then that money begins making even more money. Over time, the growth becomes exponential rather than linear. This is why experienced investors become obsessed with one thing: time. Imagine two investors. The first starts investing at 20 years old. The second waits until 40. Both invest exactly the same amount every month. The second investor might contribute more money overall, but the first investor often finishes with significantly more wealth, not because they invested better, not because they earned higher returns, simply because they gave compound growth 20 extra years to work. This is why the best time to start investing was yesterday. The second best time is today. Now let's discuss risk. One of the biggest misconceptions in investing is believing that higher returns come without higher risk. Unfortunately, that's not how investing works. Every investment carries some level of uncertainty. Stocks, real estate, businesses, even cash loses purchasing power over time because of inflation. The goal isn't eliminating risk, it's understanding it and taking only the amount of risk that allows you to stay invested for decades. because staying invested is ultimately what creates wealth. There will be recessions. There will always be headlines claiming this time is different. History suggests otherwise. Markets have experienced wars, financial crises, pandemics. Yet over long periods, human innovation has continued, businesses have continued creating value, and markets have continued moving forward. If there's one lesson I hope you take away from this entire video, it's this. Successful investing isn't about finding the perfect stock. It's about building a system you can stick with for decades, because consistency almost always beats perfection, and patience almost always beats prediction. Before you go, let's quickly recap everything we covered today. We started by explaining what investing actually is and why simply saving money isn't enough in a world where inflation slowly reduces purchasing power. We looked at the different types of investments, including stocks, bonds, ETFs, index funds, real estate, assets, and liabilities, and why owning productive assets is one of the most effective ways to build wealth over time. Then we explored how the stock market actually works, including supply and demand, investor expectations, earnings, inflation, interest rates, market cycles, and volatility, and why prices often move long before the economy changes. Next, we broke down the biggest reasons investors fail, including FOMO, loss aversion, panic selling, trying to time the market, recency bias, and emotional decision-making. Finally, we looked at what actually builds wealth over the long run: compound interest, time, index funds, dollar-cost averaging, risk management, consistency, patience, and long-term thinking. If you understand these concepts, you're already ahead of many investors who have been buying stocks for years without truly understanding how investing works. If you enjoyed this video, make sure to subscribe to the Wealth Blueprint. Every week, we break down investing, business, banking, and economics into clear, engaging lessons designed to help you make smarter financial decisions and build long-term wealth. Thanks for watching, and I'll see you in the next one.